gold hit a 4-week high today, and the outlook does appear to be relatively positive. At least that's according to Goldman Sachs. The firm predicts gold may rally to a record $1,300 an ounce in 6 months, driven by a flight to quality by investors. Let's see what that might mean for gold stocks with Robert Cohen. He's a portfolio manager of Goodman Company's Dynamic Gold and Precious Metals Fund. The fund's performance puts it in the 96th percentile among its peers over the past year. And Rob's joining us now with more from our newsroom in Toronto. So, Rob, a lot of people have been looking at gold recently. Something I have to say, have been trying to puzzle out over the past few days is that while stocks were going down tomorrow and people seem to be getting, yesterday, excuse me, I don't know what they're going to do tomorrow. While people seem to be getting out of stocks and other risk assets yesterday, gold was not going up. Why do you think it wasn't benefiting from that movement?
Oh, perhaps there's some degree of behavioral finance in place where maybe it takes an extra day for investors to digest things and decide once they have their cash in hand from selling their stocks yesterday, where are they going to put it and what safe haven areas can they apply those funds. So today is a bit of a beneficiary for the gold stocks and the gold price. Of course, we haven't hit some of the 52-week highs, but I think you got to look at gold as something like a bouncing basketball and walking up a hill. And there's too many people that are focused on the daily volatility of the gold price and watching the basketball going up and down, but they're missing the whole trend. So yeah, I totally agree with the Goldman Sachs analyst there. $1,300 an ounce is within reach. Generally speaking, we're seeing gold moving up very steadily for the last decade, about $100 to $200 a year.
Is there anything, though, that could derail that move?
Oh, perhaps a very strong global economy and a lot of confidence in paper money. But what we've had here is not a lot of confidence in the economy, not a lot of confidence in what's happening with central banks around the world and their need to print money. So money supply in itself has expanded quite massively. Velocity of transactions is still quite low. Yeah. So, but not with that said, you have had there's such a strong correlation between global money supply and gold price. In other words, as people have less confidence in paper money, it takes more paper money to buy the same amount of gold. And so Rob, you'd literally have to destroy money supply to make the gold price go down.
And Rob, also today, I would imagine for investors too, piling into gold after that jobless claims number came out, correct?
Oh, absolutely. Gold is a barometer for all the macroeconomic factors in the world. So when we have fear about the economy or the value of paper money, sure, people are moving to gold.
I want to ask about some of the stocks that you're looking at here, and I see the top stocks, the top holdings in your fund: Cisco Mining, Sandgold, Perseus. These are obviously not some of the gold majors, at least not here in North America. Tell us about some of these companies.
Well, sure. I think when I look at what I do as putting together a portfolio of stocks, I actually don't want people to necessarily recognize all of my top 10 names. I'm doing a deeper degree of due diligence, getting onto stories in an earlier stage. And so, for example, Cisco Mining, which is one of our top holdings, we are probably, our fund is the longest term shareholder of this company. We're really the first institutional investor into this name. And I've seen this stock go from literally 30 cents to $14. Right now, the Canadian Malartic deposit, which is their flagship property, is under construction. It will be starting up early next year. And because this will become the biggest gold mine in Canada, there's certainly right now a lot of takeover rumors around it right now.
Rob, we're sorry, we're running up against a break. Rob Cohen, thanks.